All right. Good morning, everybody. It's Monday. So we're kind of flat. The Russell's down the most, small caps also hit the NYSE when we finally start getting a reading on it. Europe's doing better, up more than 0.5%. And Hong Kong with Japan both basically flat. So really, the S&P and the NASDAQ has kind of just pulled it back together a little bit. It's an interesting week. This morning we've got PMI. This is going to be at 9:45, so there won't be no gap close play. Not necessarily. When it comes to those gap close plays, you can get them even intraday. All you need is a big candle. The one from Friday with non-farm payrolls, perfect. It did exactly what it was supposed to do. We get the opportunity for 3 of those a month: non-farm payrolls, CPI, and PPI. But the PMI today is going to be during market hours. We're going to see more Fed speakers. We had Powell over the weekend. Now we're getting Goolsby at 10 o'clock. Also, we're going to get ISM, and then we're going to get Bosick this afternoon. So it's like I mentioned, when they come out of blackout mode, they're going to want to solidify the things that Powell said and maybe walk back some other things. So listen for them to all be talking about the same thing. Try to, they'll reinforce a message. They all want to act like they're independent parties, but at the end of it all, you know, they're all going to parrot the same thing and sing from the same hymn book. If they don't, then that discrepancy is something the market is really going to latch a hold of. And we've seen how that can work from November, you know, into the new year, how they were pricing in rate cuts, even though the Fed didn't say anything about a March rate cut. So (9:45), 10 o'clock, 11, 11:30, and then 12:30, 2 o'clock. It's a full house across the board all day long today. We're going to be getting things out of England, the US. So especially after the Globex range that I seen all night last night, I wouldn't be surprised if we chop about quite a bit. Still don't see any sort of mean reversion owed to us. You know, that old question, have we gone too far, too fast? Does it owe us a pullback? Not seeing any of that yet. McDonald's did good. Ooh, yeah. So for those who aren't quite familiar with this setup that we go through, indices from around the world. This is free. It's investing.com. Just hit this up, give you an idea of what's going on, and you can kind of check things, commodities, bonds, stocks here on the side, but gives you an idea of the markets that are around the world, what they're doing. Market Watch, they really just try to stick to the biggest events and US events. So a lot of times it'll say there's no event for the day because they just don't see one that's big enough to be worth mentioning. I like this one for kind of a broad-based idea, or to ask that question, what's the most impactful thing today? Because if it's the biggest impact, it'll probably be on this list. FX Street, these guys grab just about everything they can get their hands on, and they don't care what nation it's from, but they do a good job of letting you know what nation it's going to be from. They have the impact meter as well. So if you're newer to trading and you're not sure which of these you should be worried about, it has a meter giving you a historical precedent. Does this particular economic event have a history of being violent or volatile? Now, that's no guarantee. They always mark these auctions as if they're low volatility events. but these auctions are something that I pay particular attention to. And it seemed for years that I was the only one even looking at them. But, I keep pounding the drum and mentioning how impactful they are. And once you start looking for them, you see that move more often. So, it's not a perfect system, but all of these pages are free. You don't need an account there. And while it might seem like we're just looking at the same economic events on every single page, there's a reason that I go to each of them in turn. Same thing with Finance Juice. It's going to have economic events on the side, but Finance Juice, unlike FX Street, Finance Juice will also adapt to new speakers or somebody who's scheduled to speak that maybe wasn't scheduled Friday, right? Maybe over the weekend they suddenly got put on the schedule. Finance Juice is very likely to pick up on that and let us know, hey, this person's going to be speaking. Whereas FX Street, they're a little slower to respond to changes in the speaking schedule. So I like to hit these up. Plus, Finance Juice has these session preps. So if I was to click this link, it would give us a rundown of what happened in the overnight hours and what happened this morning with earnings and everything else. But it also does a market wrap for every market close. Now, Europe's not closed, but the US is kind of waking up, coming online. And so they do us they give us a solid here. They do a Europe wrap for us, even though Europe isn't closed yet. So if you scroll back, you would see an Asian wrap. You would also see a US wrap because when we close, right, they offer the same to others. So this little bit can often explain what the heck happened, right? If you're looking at a chart on an intraday and you've seen this big move and you just couldn't figure out what the heck that move came from, this is a good place to start when you're trying to figure that out. Finance Juice also has a free version of Tick Strike. Hey, you get what you pay for, but this thing has gotten me into trades because it got my attention when I wouldn't have been looking at the market at all. So turn it on. It's just audio, but that thing starts picking up. It's letting you know flows are coming in. That brings you back to the charts and you can see, oh, hey, we're breaking out. You get an opportunity to trade. It's kind of a bit like Jigsaw or Bookmap, one of those order flow tools, but there's no visuals to it, right? You just turn the audio on and you're good to go. There's a paid version, but all of these things that I mentioned are free. I don't even want to get into the paid stuff. I've got a lot of those, by the way. All right, so we had a pretty good week last week, and I don't know, I tried to short Facebook earnings and bought went long Apple earnings, so obviously that didn't work too good. But other than those two things, the discussions we had last week in the morning briefing for what the S&P and really the indexes, what they're going to do, nailed that last week perfectly. So it kind of balances out a little bit, I guess. PMI, ISM, additional auctions at 11:30. Fed speakers this afternoon. You're going to want to watch the clock, right? And I've had people ask, what does that mean? Is there something particular to that? No, seriously, put a watch on your wrist, get a clock, put it in your office, something. What time is it? The government is lazy. It does everything on a schedule, right? Markets open on a schedule. Treasuries and bonds open before we do, 8 and 8:30. They close earlier than we do, 3 o'clock. This is where power hour comes from. We get these additional auctions at 11, 11:30, 1 o'clock, right? Econ comes in on schedule, 8:30, 10 o'clock. So watch the clock. It's one of the most powerful indicators you can use besides price itself. If we look at this run that we've had and the breakout, the follow through, kind of looking for a buzz beyond this, right? So old resistance becomes new support. very often price will pull back and validate that support. The entire concept of what I just said, we wrapped that up into a single word, Busby. So we broke through this zone or this range. It would not surprise me to turn around now, come back and retest it. That wouldn't even put us in a bearish posture, right? If you think about the normal average pullback, around 5 to 7% is a good, decent, normal pullback. That last one that we had that was an 11% pullback, that almost put us into triggering some volatility levels. It was a pretty big pullback, but it was tied in with QRA and everything else. And what we want to focus on is that this pullback that we're likely to get, it doesn't owe us one. We're just likely to get one. And it could very likely not be any bigger than the last one. The other one was 2.8%. We could get, maybe 5%. 5 to 7 is what we were getting pre-COVID. I don't know how many of you were trading, before COVID hit, but, we were in a general broad bullish market for the last few years up into COVID. And we would get these pullbacks of 5 to 7%. It was like a good reset, right? Everything gets so overextended. You really don't want to trade anything or buy anything. You get this good 5 to 7% pullback and kind of resets the board. And then you get another leg higher again, right? So if we were to start looking for a 5% pullback, that gets us just a little through that line that I have, that zone that I marked out here, but it's still higher than this last low, right? Which would give us a higher low. It's kind of what we want. You don't want, a lower low at this point. So I'm not saying we're going down. I'm not even saying that it owes us a pullback, but after this kind of breakout, getting a pullback, getting that Busby would make perfect sense. This morning, when I zoom in on this, it looks like we got a really big zone, but we don't. That's what, 10, 11 points. It's really tight. The volume is normal. Nothing stands out here. It's not extreme. It's not really light. It's a little closer to light than it is normal, right? If we got 60, then we'd be a little concerned. 77's okay. It's a little light, but it's fine. I mention this because you got to get used to looking at the cumulative overnight volume. It's a nice tell for what happened last night. It starts at midnight and it just starts counting if the volume was positive or negative, and it just adds it up all night. So somebody asked me last week, how do I know what the numbers are supposed to be? There was no book for it. I just kept watching them every day, and I started to get a feel for what normal looks like. It'd be nice if there was some kind of manual or book, but if you're going to use it on something other than the ES, you're going to have to do the same work, because I don't know normal for every market. I know normal for ES. So if you want to use it on oil or whatever, you got to watch it for a while, and you can scroll back, right? It's not like you can't look back and try to find what the average looks like. We're looking for overnight participation or a lack of, right? If it's really heavy, we want to know why. If it's really light, we want to know why. Otherwise, we come in and it's just normal, like we found it this morning. Nothing really stands out. Just get it out of the way, because it takes up a lot of real estate. We don't have an MDP this morning. We've hit it multiple times, but we've hit it and it's held multiple times. So I'll just kind of zoom in here a little bit. We can see along these lows. Remember that liquidity resides on the other side of the pivot, right? My VWAP starts at midnight. So really that was the start of it all. We've been getting a good reciprocation. We got a little deeper on the bottom side here, so I would expect a little more off the top. But just like a jigsaw, if you've ever used one of those, or a reciprocating saw, you get what you give. So We're kind of in a sloppy balance, just bebopping back and forth across this. And every time we set a level, we're going to expect the next time we get there to go a little farther, right? Liquidity resides on the other side of the pivot. So we set a high up here and we punched through it just a little bit more. We set a low here and we punched through it just a little bit more. So this starts to create what we call a megaphone pattern. It'll begin to widen and get a little sloppier, wider and wider until finally it breaks and we make that move. We're inside day, which makes perfect sense because Friday was a really big day. Thursday was a really big day. To get out of that range to the downside, we've got a lot of work to do. And this is one of the things that's going to be difficult. Friday, we did an excellent job calling this move all the way to 5,000. Now, we didn't get to my target of 5,000, but we got really close. And I was calling that level at 9:30 in the morning. And I continued to call it all day, even through all that sloppy stuff that made it a little tricky. The price action was not good, right? It wasn't because there was some kind of pattern in the price and the candles and said we were bullish. That was some sloppy stuff. It was this bias that kept the long trade on. That really tight range that we had Friday is the same kind of tight range that we have now. The difference is we don't have a pre-market event. We have a 9:45 event and then all these Fed speakers. So we could get an intraday candle, kind of like back here, how we had a really big intraday candle. And then we get a gap close from that, just like we did back here. But for a downside move, you know, we got to go all the way down to basically 48, really 48.50. You know, if we wanted to be exact, is 48.66 to the previous week's low. But I mean, really, to get past that option level, 48.50, it's also a voodoo line. It's down here. It's a really big deal. That would get us a lot closer to the 10-week, which we're still a long ways away from. All right, so level by level, the call wall is 50.22. It's close to the full ADR. The ADR half is at that 5,000 mark from yesterday, Friday. We've got a voodoo line, which is this white line, 49.76. It's a white voodoo line, so it's kind of a big one. The put wall is really close to us. It's at 49.50, which is right at the ADR half to the downside and barely above the weekly pivot point. So we're surrounded by a lot of things. This put wall is kind of like support, but it's also where they would monetize the puts and then try to run it up from there. So it's a place where we would expect buying. Sounds like support, right? Same thing with the call wall. This is kind of like a resistance. It's where we would expect them to sell calls. Sounds a little bit like resistance. Rolling up the put wall is bullish. The fact that they brought it up like that, that's a bullish bias. It kind of shows what they're thinking this market's going to do. And rolling up the call wall is bullish. Just that, the nature of what they did implies a bullishness. So if we can get through that voodoo line 49.76, we'll target the roundy at 5,000. That would give us a inside week breakout, and we'll get to that ADR half. it's very likely we digest there. We can overshoot it, kind of just chop about. We'd look to keep that breakout though. We don't want to give it back. And it's hard to see that we get through the call wall unless one of those Fed speakers say something really exciting. On the other side of that, we could get negative instead. So we would focus on getting through the daily pivot point or our own Globex low. Get through that. We'll get to the put wall and the ADR half. It's likely we overshoot that, maybe get into the weekly pivot point, but not really expect it to expand much beyond that. And we would just digest around that zone into the end of the day. Unless one of the Fed speakers says something really crazy, then, he could push us towards that 10-day moving average, which is Friday's low and or the full ADR 49.25. So we can get there, right? There is a path to see us there, but I think it's going to have to be either through that econ that we're going to get this morning or through one of the Fed speakers to really give us enough push to break a lot of these pivot points, because that's a lot of pivots. And they're not minor pivots either. Those are really big, really powerful pivots. All right, we talked about last week this range getting a lot tighter and the shape of the 10-day profile turning more towards a B scenario, lowercase. If we continue to sit in this higher zone, we'll start to develop the D. All right, now we've left the point of control quite a ways below us. We're really focused on this 49.80 zone at the moment. It's going to be a little tricky to get through that 49.75, 49.80, this whole area here. The Globex low really doesn't have any help. Got a bit of an air pocket below that. So if we can get through 49.55 or so, looks like if we can get through this price shelf, then we could get back down to that 49.32 cog line and back inside the 70% zone. We don't have a VPOC from Friday. And we don't have any overhead. So that's a good thing. To the downside, we still have that 48.92. It's just so far away, right? There's so many other things in front of that. A cog line, 49.11. Another cog line, 49.32. An optionality level, 49.50. So those are major points all on their own. Even the roundy at 4,900, another strong option level. Not to mention floor pivots, weekly pivots, right? Yesterday's low, yesterday's open, Globex low, all of those pivot points are going to be levels that we got to fight through to a move to the downside. We're 1% above the 10-day moving average, which is nothing. When we ask that question, are we overbought? Did we move too far, too fast? No. Does it owe us a pullback? Nope. So, linear regression, dot plot statistics, least squared methods, mean reversion, it doesn't owe us one. We didn't get that extended. Looking at it on the weekly, we're getting closer to 3.25. But we can look back and see we've been higher than that before. So we're a little overbought on the weekly, but we are on the way down, right? After kind of cresting and rolling over a little bit. So does it owe us a pullback? No, but we could pause a little bit. Remember that the 10 is going to come up to us even if we go up, it's still going to follow us. So if we don't go up fast enough, it'll catch up with us. If we don't go up at all and we just kind of hold and go sideways, it's correcting through time rather than correcting through price. The 10 is going to catch up with us. Or we turn around and we go down to it. And then, of course, we catch up with the 10. So we're looking for a little bit of that reset. It's healthy. It's good for the market. And if we want another leg higher, then we need this reset. So we're not overextended. We're not overbought, but we're getting kind of close on the weekly. Closing outside of this box, even by just a little bit, it counts. The S&P is supposed to close inside this range on Friday, 8 out of 10 weeks. So that counts as a week where we closed outside the box, even if it is just a little bit. One of the things that we want to do on Monday is make sure that we know the range, the amount of volatility we have compared to last week. Now, remember last week we had QRA, FOMC, and all these events going on, non-farm payrolls. And yet this week has more volatility than last week. We know because these ranges are built using volatility. The more volatility there is, the wider the range is. And this week's range is bigger than last week's range, which implies that this week has more volatility. That should make you pause and wonder, why do we have more volatility now than last week with all those big events like non-farm payrolls and FOMC and QRA? Something to consider. These 9 sectors are pretty much the market, right? There's really more than 9. There's more than 11, but I like these 9. And the group, the way that I have them grouped is across the top would be a risk-on market, a good economy, just a bullish backdrop to the broader market. The 3 on the bottom is more of a defensive rather than offensive market. This would be for, a market in an economy in contraction, a bearish backdrop. And the 3 in the middle is our midline sectors, tend to do good in any kind of market. Of course, if we're, if it's a real heavy bear market, nothing does good in a real bad bear market. But in a slowing economy, that kind of situation, these 3 would still do good. So risk on, risk off, and midline. From staples to frivolous spending and discretionary spending, technology, finance, healthcare, utilities, energy. I added the label so that when I come in here on a Monday and I look around, kind of asking the question, what happened last week? Not just did we go up or down, but by how much? A 5-day change percent. And where was the money flowing? Where did money leave and where did it go? Sometimes it's really clean and it stands out easy, and other times it's a little muddier. This was a reasonably decent broad move last week. Energy went down some. Yeah, it closed closer to a 1% to the downside. But when we look around, discretionary 3.25, or healthcare 2%, staples 2%, industrials almost 2%. So that's pretty diverse right there. Financials almost 1%, and technology really close to flat, 0.25% for the whole week, in line with utilities at 0.5% for the whole week. So where's the money flow? Not tech, right? Maybe it's coming back into tech. Of course, it got whacked a little bit, right? We had a couple of those earnings that really brought it to the downside, but it's trying to come back up. It was down worse than that. But on this screen also is the purple line and the orange line. Purple is 200, orange is 50. When price is above both of those moving averages, you've got a strong, healthy market, or let's not say strong, but a healthy market. If price is above those, but the 50 is underneath the 200, then there's a market in question or a market that's healing. So there's a lot from this, right? Rather than just looking at the label. So one thing that stands out is we had this 50 cross on healthcare. That was back near the start of the year. So the 8th of January, somewhere around there. 50 above 200 and price above both. That's a good, strong, healthy market. It might not be, ripping to the upside with abandon, but it's up 2% in a week, while tech is down to, it's only up a 0.25%. There's white dots here. This is linear regression line, like a LinReg. And it does have a slope to it, right? It is slightly turned to the upside. Same thing with staples. There is a slope to this. We're up 2% in a week. The 50 has not crossed the 200 yet, but price is back above the 200. That's step one. The 50, unless we just crash and burn, is almost inevitable to cross at this point. That'll be step two, getting the 50 above there. So things are turning around in the market. The money flow, we want to look to see where that change is. Looking at what happened is only part of it, right? We got to try to anticipate. Can't do it all in the past. I went through all of that because we're looking at a market that had some crazy moves on Friday. We had the S&P up, the NASDAQ up, and the dollar. Look at what the dollar did Friday. And Japan, the US dollar Japan, during our market session. And the 10-year. It's not supposed to be this way, especially with such big, radical moves in the 10-year and the dollar. When you get these big upside moves like this, you should not see the S&P and the NASDAQ up on the day like it was. So something's going on. There's a change coming, and this is screaming caution, warning. So just be careful. If you're holding trades, the swing trades, and you've got some profit, maybe take a little off, or defend what you're holding, because this isn't right. We are starting to see a continuation this morning in the bonds to the downside, and we're not seeing it in stock yet. We still got the NASDAQ above VWAP, the ES above VWAP. I don't have an answer for why. I'm just pointing out that this is really wrong. Something's off, and you want to be careful. I went through this last week, but I think it's worth going over again real quick. These pink lines are FOMC and QRA for the last year, for 2023. And I really think that this is what we're going to get between now and May. So a little bit of a roadmap. We just got QRA and FOMC. We're expecting a bit of a weakness into March. Then the Fed will have a March FOMC. And then, maybe a bit of a rally back out of it, almost back to where we were for QRA in May with FOMC. Will it be exactly like this? No, I mean, that old phrase, markets and rhyming. But that's the base case argument right now. That's kind of what we're expecting. And what will the 10-year do during that? We're looking for a move to the upside. Then it'll start basing and maybe pull back again before FOMC. Well, I mean, that's what we're getting this morning, right? That's what we got Friday, was a big move in the 10-year. So, is this what we're going to get? I don't know, but approach with caution, right? If you're eyeballing some new longs, just maybe start with a smaller position size. So things that are down this morning: bonds, building materials, gold miners. So a pretty broad spectrum to the downside. And things that are up: what's that? Bitcoin, semiconductors, China ADRs, and the FANGs, or the MAG 7 at least. For things that are up, we've got no energy. XOP, which fits into energy, is down a little, but my benchmark is 0.5%. So if it isn't down at least that far, then I don't count it. I don't even look at it. So like, uranium, XLE, all these pot stocks, it's a negligible amount, 0.25%, maybe 1/3%, but I don't focus on them unless it's at least a half. I'm lenient, right? There's other analysts who do a morning approach similar to this, and they don't look at it unless it's up or down 1%. So, using 0.5% is considered lenient. But if I went with a 1%, there'd be a lot of mornings where we don't even have anything to look at. So silver is getting a little weak, but it had that really nice bounce on the 200. Kind of see the history of it back here from November also. So hit that $20. I said 200, but hit the $20 mark, bounced, came back and tried it again with another bounce. Keep in mind that while this is looking like a double bottom, if it's going to be a real double bottom, it should go lower than the previous low. If it goes back and it hits the same spot, it's very likely going to be a cup and handle. If it goes back and overshoots the previous spot, then we're looking for a double bottom. And so far, this is looking more like an inverted cup and handle. So I liked that bounce on $20. And, you know, it had a nice run, a $3.50 move before it gave it all back. And now I think if we come back and retest that 20 again, I think we're going through it. We could get a nice move down to 19. All right. Well, I'm a little suspicious of the Russell. It had that really nice breakout, and then it came all the way back down and it fell back into the breakout. It's back out again, but it shouldn't have been that weak. So I don't like that it got back inside this level. So, you know, things can overshoot. Last week we had a lot of econ that really rocked the markets, and this could have just been, you know, a little bit of that overshoot. Sometimes it happens, you know, it's not like price is perfect. So I'm going to stick to my suspicions though. If you want to use this reversal bar, that is a really good reversal bar, and you could use it for your signal up. If you want to be a little suspicious, you measure the entire zone, mark the 50%, get a close above that level. You don't necessarily need to wait for it to run all the way back up and get above 205 and then break above that. I think that's waiting too long, really. We don't need that kind of conviction. So if you don't want to use this as your reversal, then the 50% mark would be really good. Get a close above that level and should be good. I just don't like how it broke down, and so I'm a little suspicious. So we got the China ADRs, Bitcoin, and that's it. The rest of these aren't up enough. With the China ADRs, that gives us BABA, Baidu, JD, PDD, maybe even some of the EV names, XPEV, NEO. And for the Bitcoin space, HUT, Hive, Riot, Coin, Mara, MSTR, any of those would fit. But we've also got ones that don't necessarily stand out when you think about, you know, crypto. So my crypto list has things like NVIDIA, Taiwan Semiconductors, AMD, and then, of course, Mara, Riot. It could be a little bit of a canary in the coal mine. Yeah. I'm telling you guys, with this issue here, this dollar 10-year explosion that we had last week that moved with our market and not against it, we have to just stand back and say that our normal approach to analysis is befuddled right now. Because if this is wrong, or if this is off, what else is off? What else should we not trust right now? So kind of really want to approach with caution. This is the Mag 7. It's up again in the pre-market, just another gap up. I've got it on a weekly, but when we put it on a daily, you know, it still looks bullish. This is bullish in the bigger backdrop but we can have a pullback, right? And it's not like we're looking for, down 10, 12, 15% in the S&P. It's not going to be like that. But I wouldn't be surprised if we go to, 3 to 5%, maybe 7. The craziest thing is, though, we don't have to pull back. Some of this violence could be the fact that the market's getting ready to break out, even though it is up as much as it is, that it could break to the upside and run another 3 to 5%. It's funny that, everybody kind of understands the idea that when price goes down, the VIX and volatility go up. But if we go up really far, too far, and then we start seeing the VIX going up while we're going up, because the market is getting so nervous about how far up we are that volatility goes up even when the S&P is going up. So this white line here on this market, this is the NASDAQ composite rather than like the NASDAQ 100. And the white line in the background is the cumulative volume for just this market. But if we go and put it on something like the S&P, now it's cumulative volume, so we can choose what volume we want, the NYSE, the NASDAQ, but we're just going to do all of the US markets. Cumulative volume, it's still up there a lot, but see the divergence? So we're making lower highs in this tool, and we're making higher highs in price. Matched with this divergence from all the way back here, price making higher highs and just continuing to the upside, while this, no. I mean, if you're looking for day trades, that's not a big deal, right? If it's just day trading, no issue. If you're looking for swing trade stuff, you need it to resolve first. You don't, when every tool you have is broken, you don't try to figure out how to read broken tools so that you can trade anyways. You GTFO and wait for the tools to start to function again. This is signaling something significant, and it could be that we're going to break out and continue higher against all logic and reason, or that we're going to get a good, healthy pullback of that 3 to 5%. But why do a coin toss of either or when we can let them settle out first and then make the decision at that point? And we still already have that expectation that we're going to get, because of the QRA, that we're going to get a bit of a pullback in the market. But say we don't even get a pullback or a breakout. We just sit here and digest for the next month. It wouldn't be the first time we've gone sideways for a month, right? We get a market like this where we just do nothing. So, it's not always about trying to find the next trade. When it comes to technical analysis, the entire concept is based on the idea that we can recognize patterns through history and then apply that going forward. But when price is acting irrational and not doing anything that it's supposed to do, just recognize that it can't use technical analysis on it. So we need more information, or we need it to break. If it does break out, is that good enough for a trade? I mean, I trade price. So a day trade Sure. A short duration swing into Friday, even. Sure. But I'm not going to go, get a bunch of swing trades for the quarter because we don't know what we're going to get out of the quarter yet. So this morning we got semis, China ADRs, and a Bitcoin. We've got some places to focus on for some day trades. And, short duration swings. Everybody have a good one. Be careful, be safe. I'll see you all tomorrow.